Bull markets don't destroy capital, but they can breed behavior that does. And I speak this from experience. And my hope today is to inspire you to look at your own process, especially as we go through this bull market, which we've all been waiting for, and make sure that your process eliminates some of the emotions that can come or the blinders that can form when you you experience bull markets. So my success over the last 10 years has been built obviously off a bunch of learning that I've done. The process of reading books, reading everything I could on the sector, analyzing data sets. For me, having the humility to listen to mentors and incorporate the experiences they've had and the rules that they've formed, and putting them into my process to further capitalize on these types of markets. Last year was the best financial year of my life to date. And that was predicated actually off of hard lessons that I learned in 2022 and 2023. And that's really the basis of what I want to talk to you about today. Prior to 2025, my biggest success was in 2020. And I can attribute that success really to two big lessons. And those came at the hand of a mentor. And he infused in me the importance of learning how to sell, how to take profits in the market. And because of that, I did that across 2017, 18, 19. I had a great cash position going into 2020. And the key part to this was that he convinced me that you need to buy fear. You need to buy when others are selling. And I capitalized. I was buying, specifically, I remember those 3 days in March of 2020, those COVID crashed. And I was buying on all those days. And it set me up for a huge win later on that year. And then finally, 2016 is when I became a full-time investor. It was based off good stock picking, obviously a high risk tolerance, definitely some patience because it took 3 years to sort of get to where I thought it would, and a whole lot of luck to sort of experience or have the confluence of all those things come together. But what I wanted to talk about today was loss and failure, and specifically a cascade of events that were the result of a bull market. For those that may or may not know, I was an early investor in Abra Silver. I was buying the stock at 2.5, 3 cents, basically when Abra and at that time Aethon Minerals were combining. I liked the project. I most of all liked the management team, John Miniotis, David O'Connor, had a lot of confidence in them. And I started buying that stock. And if you look now, Abra Silver is a $17 stock. It's been a whirlwind. It's obviously been my biggest winner so far. And I'm not going to take full credit from the whole thing I've been buying and selling throughout that time. But it was a big deal. And so I stretched this back. It was basically in April of 2020. Like I said, the market had crashed. They did a financing at 6 cents. I participated, and you got warrant, I believe, at 12. And then 3 weeks later, and this was the important financing, it was at 8 cents, and they had a further warrant at 16. Excellent. Or at the time, I was actually pretty nervous in taking that deal, considering everything that was going on, but I did do it. Later that year, as you all know, in retrospect, that was a great 6 to 8 months of bull market. The gold price went up. The equities went up, especially. Abra Silver went from 6 cents to over 80 cents. And I'd sat there and I was good at taking profits, and I had some cash. I'd obviously taken some profits, but I had these warrants. And I sat there and I thought to myself, everything looks like the gold price, the silver price, it looks like it's going to keep on going up. They had spent more money in 4 months in 2020 than they had of all the history of the United States, accumulated this huge amount of debt. Everything sort of pointed towards things continue to go higher. So I decided that I was going to sit. I've got another year to wait on these warrants. I'm going to wait. Unfortunately, I was absolutely wrong. And the bottom end fell out of the market. The gold price retreated. The equity prices retreated, not because Abra did anything wrong, but because that's what happened in the market. And these are the ebbs and flows of the market. So that share price came back. It settled in the 30s and kind of meandered in there for most of 2021. And then I finally decided, hey, I'm going to exercise those warrants in the 30s. So in essence, I still made money, yet I was left with this feeling like it was a loss. And it was a loss of potential gains. And this is a really interesting thing that you're not going to really probably experience unless you're in a bull market. And that's sort of my point, is everything always seems like it's going to go on forever, or that you have time to sort of wait, in this case, to exercise a warrant. But I'm telling you, it's just not the case. And you have to have certain parts of your process aligned to make sure this doesn't happen. And so what I said is I still made money on this. So this wasn't the problem. The problem was actually the chain of events that happened after. So I felt personally, I've got to make this money back. I can't believe that I messed this up. And so what I ended up doing is, and I didn't have this honed into my process, but I over leveraged myself into exploration. I picked good companies that had good targets, and I went full bore after them. And unfortunately, for a variety of reasons, even outside of drill results, I was wrong. And I lost around 60% of my portfolio or my net worth over the next 2 years. And I sat there in 2023 and I thought, wow, like this is crazy. There's no way I can put myself in this position again. And so I reviewed my whole process, and the whole thought was I need to bulletproof it so that I can perform not only in the bear market, but the bull market too. And I put this graph, and this is a very real graph of basically showing where my net worth has gone. And I show that for one really big reason, is because no matter who you are in this business, you're going to have success and failures. And for some, those successes are going to be a little bit bigger. For some, those failures are going to be a little bit bigger. But the point is that if you learn from your failures and then double down on what makes you successful, you can be on the upside, and you can overcome these dips in net valuation or portfolio value, which I think is a really important thing, because what happens for a lot of people, they ride the roller coaster up, they come down, and then they say, I'm completely done. And to me, that shouldn't be the way that it goes. Learn from those failures, and again, fix your process and learn from it. So for me, like I sold my house in 2013, pretty bold move. 2/3 of the equity go into the market, into like a handful of what I thought were the best junior mining companies. That whole portfolio over the next 2 years went down 35%, which is significant. I'm not going to take full credit for being able to sort of live through that. I had a full-time career, good paying job. And I thought, hey, you know what? If I'm wrong, that sucks. But I have the money, I have the background. I'll just make the money back. It's just going to take a little longer. 2016, I'm paid for that patience. I'm paid for the companies that I picked to get a breakout. I leave that career behind and I pursue this full time. Now, the graph shows sort of a linear step to 2020. That's not how it works. That's just how AI draws it. Really, what it was 2016 to 2020 was basically horizontal, and so was the market. But that's when I still am fully engrossed in it, but I never read as much as I read in those 4 years and analyzed data, and most of all had the humility to listen to mentors. I told this story back in January when I was on the podium. Like I was in Singapore, I was speaking at a conference there, and I was walking with this friend, and definitely a huge mentor in my life. And he was talking about his experiences and talking about how important it is to learn how to sell. And it dug into me. And he also said, if the world is truly falling apart and it's all done, what does it matter if my money is in my bank account or in my trading account? And that, again, to some that may not seem like anything, but for certain people, when they say something like that to me, I take it to heart, and I did. And it was one of the better things that I've learned and executed on, because 2020 was amazing. And then, like I said, I had the 60% rollback. That was tough to deal with. But then that forced me to make the changes in my process to really bulletproof. And that's what I've done. And not only the portfolio, the newsletter, how it's performed in 2024 before the bull market, how it performed last year, I think outperformed a lot of people. And that thing is well in line with what needs to happen moving forward. And it doesn't matter where the cycle goes. So these are the 5 factors that I took a look at after I had this failure. And I'm going to go into more detail after. But number 1, align what you're investing and speculating in to your strengths. You really have to be honest with yourself about what you don't know. Super important. Number 2, align the company stage of development with position size. There's a big difference between exploration, development, and production. Number 3, be more thoughtful with timing. Timing absolutely matters, especially if you lean towards being impatient. Then your timing has to be very good. Number 4, people. The longer I've been in this business, the more focus I have on the people that have made me money and what I would consider the top half or the top quarter of people in the sector. Pareto's rule is absolutely real. And you can find examples of companies that have interesting projects, and you think you see the value in it, but I can tell you, if the people aren't where they need to be in terms of their skill set, they can destroy that value quicker than you can imagine. So don't bother with the C teams anymore. And number 5, and arguably the most important, take profits before the crowd, rotate it into what is cheap and what is next, because often what is cheap is next. So align what you're investing in, speculating in your strengths. I would say there's probably 4 areas that you need to be or have some knowledge of to be successful over the long haul in this sector. You have geology, finance, engineering, and accounting. And the contrast I would put forward is this. If you look at exploration, to be able to look at potential, to judge risk, you probably have to have a relatively high geological acumen. You don't necessarily have to be a geologist, but you have to have some knowledge there. Whereas if you look at the producers, I would say you probably could get away with just looking at the balance sheet, understanding the health of the company, and what the growth prospects might be from that. Of course, if you've got knowledge across the board, that's obviously the premier place to be. But you want to focus on those things that you actually have some knowledge in. Jurisdictional risk. To me, it's one of those things that it's both learnt and experienced. And I would contrast it like this: like you can go on the internet, you can maybe even travel to the place and experience the culture and read about its history. But I think that one of the biggest things that I've learned just being in this sector, and especially doing this on my own for the last 10 years, is especially the tier 2 and tier 3 jurisdictions, they move in a cycle too, where they are very attractive from an investment standpoint and points when they're unattractive. And it might be counterintuitive, but I can guarantee you when chaos is at its highest in these tier 2 and tier 3 jurisdictions, that's usually when it's the least risky from a value perspective. So you sort of have to get used to that. And that's exactly how you should be investing in companies from my perspective too. And then finally, the difference, precious metals, base metals, and energy. For as many reasons that the companies that focus on those are the same, the points where they're different, they're very different. And again, I think that's part of the experience, part of learning. Number 2, align company stage of development with position size. And for me, this is all about risk mitigation and probability of outcome. And I use the first example here. So if you have a 10% position in a developer, so 10% of your portfolio, and this developer doubles and it becomes worth 20% of your portfolio, and you compare that to a 2% position in an exploration company, which to me is probably in line with where most of us should have an exploration company, one exploration company, and that's got 10x or goes 10x, and that's worth that same 20% of your portfolio. But what do you think, especially for maybe you guys in the audience, what do you think is more probable of an outcome? Now, timing does matter, but you can get the same outcome you can with the sexy exploration stock as you can with buying a developer, and you took a lot less risk. Now, that's a very simplified way to look at it, but I think it's a thought process you should go through and look at your portfolio and say, is my risk and probability of outcome aligned right with how I'm allocated? And you can see with the mistake I made, I wasn't allocated right according to my strengths, what I knew, and just generally because the vast majority of exploration just isn't going to work out. Number 3, be more thoughtful with timing. The Lassonde curve is very real, especially I would say in the bear market. Exploration is sort of one of those areas of the market where you can make money kind of no matter where the cycle is, because discovery, especially discovery on the economic side, is worth so much. The problem is that not everybody has the acumen or the risk tolerance to be in that portion of the sector at every given time. What I would say is when you have the metal cycle align with the cycle of wherever the company is, this is really where the rubber meets the road, or where you can actually make a lot of money. And you make a lot of money on the less risky stuff. And that's even the ones that are in the blue there, in the stage 2 or 3, where they're doing technical studies. Because when you align the metal cycle and the company cycle, these are often the companies that'll see the big change just on sentiment. You can get 2-3x just on sentiment change. And again, depending on your risk profile, this is again somewhere I think you can definitely make some money, and you don't have to necessarily take the risk of expiration. And then of course the tail end, that sort of feasibility study to construction to production, is really a sweet spot, and you align that with a bull market. And if I would say, if you look at how the junior stock free premium portfolio is laid out right now, we're set to take advantage of that tail. And those stocks have continued to move even in amongst this sort of correction we've had in the market that might be over this past week. People. Each one of these companies, each one of the people leading these companies today with me are what I would classify as A team or first team people that you need to be looking at. I've made money with a few of them. I'm very sure I'm going to make money with the others. They certainly deserve your questions, your time after this panel to see where those companies are headed, to learn more about the backgrounds of these people, and understand why I hold them in such high regard and they make up a big portion of my personal portfolio. Number 5, take profits before the crowd and rotate into what's cheap and what's next. And I would say if there's one point, if you don't remember anything else, remember this, because if we did a poll in 5 years, 10 years, this will be the question. This will be the answer to what most mistakes are rooted in. Most of you will not sell, or maybe not sell enough. And that will be your regret moving forward is, you know what? I should have taken those profits. I shouldn't have been as greedy as I was and been so sure that I knew what the future held. I think, unfortunately, most of us have to go through a process of loss for us to realize that none of us have a crystal ball, and as obvious as some things sound or look, it's just not always the case. Because if you look at the thesis for gold, for instance, it's been the same forever. And yet we still have moments, and especially with a metal that is not affected by supply and demand. It's all about perception and sentiment. And so when you have governments constantly spending, you have that same setup seemingly all the time, yet the gold price and the attention in the gold market ebbs and flows. I think that's evidence that none of us can really tell what's ahead. And so you need to base your buys and your sells off the companies, not necessarily where you think the metal price is headed. And you might not make as much as if you held and picked the top. I just highly doubt that, well, from my experience and the people that I know, like some really, really successful people, and they don't purport to be able to pick tops or bottoms. Field Notes. Field Notes is my YouTube channel. It follows me to the companies that I'm invested in. Great film production, cinematography. You also learn a little bit more about me, myself, how I got to where I am and sort of what's going on with how I look at the market. We did Thesis Gold, Firefly, and Hot Chili last fall. Those are there for you if you want to look. And then the newsletters. Started the Diligent Speculator at the beginning of the year. It's the lower risk, lower end of the spectrum. It's published monthly. Focuses on the producers, royalty companies, and advanced developers. Agnostic to the metal. And then you have Junior Stock Review Premium. If you subscribe to Junior Stock Review Premium, you get the Diligent Speculator for free or included. And it covers everything else. It covers the developers, the explorers, and the performance of the newsletter has been fantastic in the 5 years that I've done it. Mining cycles create fortunes. Timing and discipline decide who wins. Junior Stock Review Premium gives you the edge. Please check out the websites. And of course, if you have any questions, please let me know.